we'll shut it if somebody comes in. We're going to talk about what is commonly referred to as Obamacare. It's really called the Patient Protection Affordable Care Act. We're going to talk about some specific portions of it. Obviously, we're not going to go through the whole 10,000 pages.
Thank you.
I couldn't talk about all of them because, like the people who wrote it and the people who voted it in, I don't know all of it. I haven't read all of it. I'm not going to pretend to read all of it. I have been to 3 seminars on the topic, and all of them say, you know, they don't know all of this. So what I'm going to try to do is hit the highlights, the things that I consider the most important, and hope that we hit on whatever it is you might need. One of the things we're going to talk about is over-the-counter drug changes and medical expense flexible spending accounts. Tax penalty changes if you have an FSA or HSA, some penalties that might affect you, some changes in what we can deduct for medical expenses, some additional taxation for high-income taxpayers. This is so we can pay for this, I'm not going to call it okay. Tax penalties applicable to individuals who fail to maintain minimum coverage, and the premium assistance credit. This is something that's been in the news a lot lately, trying to get signed up for these programs and get the credit to cover those. And we're going to have fun. It's a rather dry topic, so please bear with me. The first thing we want to talk about is over-the-counter drug changes and medical flexible spending accounts. For these plans and for what's deductible, you must have a prescription for any medications, or if you have something that's non-prescription that your doctor really wants you to take. For instance, my doctor wants me to take fish oil. So she wrote out a prescription for me for fish oil. Obviously, I'm not going to take it to the pharmacist and have him fill my prescription for fish oil. He'll tell me it's out on the shelf, grab it. So, but I can use my HSA for this, and I can deduct the expense if I don't have an HSA. And of course, insulin is always deductible. Okay, I'm going to hit on the tax penalties starting in 2012. If you take a distribution from your health savings account or your flexible spending account and it doesn't meet the requirements, the penalty has been in the past 10%. It's now 15%. And if you contribute more to the plan than what's allowed, there's also going to be the same penalty. And when I say what you can contribute for a flexible spending account, it used to always be set by the employer. Now it's set by the IRS. You cannot put in more than $2,500. If you have a health savings account, which is my preference, I really like a health savings account, a single person can put in $3,250, and if you're over 55, another $1,000 for $4,250. If you're married, you can put in $6,450, and if you're over 55, another $1,000. This can become a nice nest egg because when you contribute to a flexible spending account, it's a use it or lose it. They're allowing you to go into the next year a few months to use those funds even now, but with a health savings account, the money can stay in there till you retire, and you can use it to pay your insurance premiums then. My husband and I, Max, we take advantage of this. You know, someday we'll not have our wages, but we'll have medical expenses, and that'll go toward that. And that a lot easier. Plus, we're deferring the taxes. So you don't pay tax on the money when you're putting it in, and you're not going to pay when you take it out if you use it for medical. Okay, one thing that affects probably everybody in this room is your Schedule A, your Form 1040. This is where you itemize deductions. These are where you get the benefit for some of the expenditures you had during the year and help reduce your taxes. First of all, your medical expenses that you deduct can't be something that you paid for one of these pre-tax plans that we just talked about. Obviously, that would be double dipping. And unfortunately, they don't allow us to do that. Okay, we're limited in the expenses that we can deduct. You have to have at least currently, or for this year, 7.5% of your income before the first dollar even counts for medical expenses. And now that has gone up to 10%. So your first 10% of your income of your medical expenses, you know, get a tax benefit for. unless you're over 65. And you can still stay at 7.5% until 2017, at which time they too will be limited over the 10%. Another significant change, you know, we have all of these increases so that we can pay for this plan. And one of the big changes affects the Federal Insurance Contribution Act. It's called FICA. A lot of people refer to it as Social Security taxes, but this is the real name. And it has two components. The first component is the Old Age Survivors Disability Insurance on Earnings. This is for your Social Security benefits built up through your withholding at your employer, or you have to pay if you're self-employed. In 2013, it's 6.2% up to $110,100. That's higher than what it has been. I think it was $108 last year. And of course, your employer matches that 6.2% to go into your fund. Now, they've talked about taking off this cap altogether in some of the things that are being randied about in the Congress and the Senate as far as in their new tax plans. I don't know. There's going to be a lot of high-income people really object to that. We'll see how much power they have. Hospital insurance, this is also called the Medicare tax. And right now, there's no limit on how much income you can have to be able to still be paying this tax. So it doesn't matter if you make more than $110,000, you're still going to pay Medicare tax. If your payroll, if your salary is $1 million, you're going to pay that on the whole thing, the 1.45%. Of course, so that's matched by your employer, unless you're self-employed, in which case you have to pick that up. Now, if there's something new, who could do a drum roll for me? Thank you. We have an additional 0.9% Medicare tax. The employees will pay this, not the employers. And it is, like I said, an extra 0.9%. Add that to the 1.45%, and you're going to be contributing 2.35% of your salary to Medicare tax. That's going to add up for people that it affects, but it only affects you if your income is over these amounts. If you're single or head of household, if your earnings are more than $200,000, you're going to pay this 0.9% on the whole thing. And if you're married or your surviving spouse, it's $250,000. This is one of those things that kind of frighten me, and I'm getting off on a tangent here. Because if you're single, you get $200,000. If you're married, it's not double, it's just $250,000. And it's not based on just one person's earnings, it's on both. So if one taxpayer makes $150,000 and the other spouse makes $125,000, we're looking at $275,000, and so they're not having the withholding to take care of that. And so this is going to hit them, and they won't have paid in. And so when they come in to do their taxes, they're not going to be happy campers if they were aware of it. And they really, again, discourage married filing separately because it cuts off at $125,000. If these affect you, please see me. Okay, and this is one that's gotten a lot more publicity, I think, and that's the net investment tax. We've got a lot of people really unhappy about this. It started January 1st, and you're going to pay the tax on either the lesser of your net investment income or what they call modified gross income, and we'll get into that, over a certain threshold. Again, this is going to affect more the higher income people, but it is going to sneak in there, and it's going to affect some of the lower income people in a certain circumstance. We'll talk about that. Investment income includes these things: interest, capital gains, royalties, dividends, your taxable annuities, and then passive rental income. The thing that's going to hit some people that wouldn't be expecting it is if they sell their home and they have a sizable profit on that home above and beyond what the IRS lets you exclude, you're going to pay this net investment tax. Now, we made reference to the thresholds for investment tax. These are the people that it's going to hit. Do these amounts look familiar? Just like what we talked about for the Medicare tax.
You meant like on my own.
Yeah, and even $200,000 for single or head household, 250,000 married again. We don't have 400,000, we just have 250,000. Shame on them. Nobody's gonna wanna get married. 125,000 married families separately. And the kind of income that makes up this threshold is, we go through and prepare your tax return just like we would otherwise. We get this adjusted gross income at the end after we've added up all of your income and taken off of any adjustments to income you have. They take that amount, they add in any tax exempt interest, you know those bonds and those things that we invested in so we wouldn't have to pay taxes on? That's added back in. And the portion of your Social Security that's non-taxable, you know, you don't have to pay on your whole amount of Social Security. It's based on a lot of different income sources and so forth. So everybody has some of their Social Security that they don't have to pay tax on, and that's going to be added back in to make you part of that threshold. And if you think this is going to affect you, we need to talk. Okay. Now, I think we'll talk about that individual mandate to maintain health coverage. This starts January 1st. We've had so much publicity about it lately. It's not something that our government has really been successful at setting up for us. The first thing that we need to talk about is that it must be at least equal minimum essential coverage. That means so much, and if you have a specific question about that, let's talk about it. If you have an employer's plan or you have Medicare, you already are going to meet the minimum amount. Employers had to notify their employees within the last half of this year whether they meet the minimum amount or not. Now, just this last week, since so many people were losing their insurance, President Obama decided to let the insurance companies have a while longer to meet those guidelines before they can no longer offer their insurance. So that should make a lot of people happier. And if your coverage is not maintained, or if you don't meet specific exceptions that we'll look at in a minute, each month over 3 months you're going to have a penalty. Now some people are saying, oh, that's only $95 a month, I'm not going to worry about it, I'm still not going to get insurance. It's not that simple. It's really not just $95 a month. Or $95 a year, I'm sorry. Okay, here are some exceptions. These are the people, this is who does not have to participate in a covered plan. If the cost of the plan is going to be more than 8% of your income, if you can't buy insurance for, and you're more than 8% of your income, then you don't have to take out the insurance. It's an exception for you. And if you don't have to file a tax return, your income is low enough that you don't have to file a tax return, you don't have to take out the insurance. There are some hardships that can be recognized by the Secretary of Health and Human Services. I'm not sure what the process is to get that, but I guess I'm kind of thinking, hold your breath on that. You know, I don't have any more information on that. Does anybody else have any information on how those hardships, what they could be? What you do?
I do not.
Okay. Of course, there are those that their religion prohibits them from having medical insurance, and we have to respect that. If they're not legally present in the United States, they don't have to take out their own insurance.
That's great.
Right? That makes a lot of us really happy. And if you're a member of an Indian tribe, you don't have to participate. They have their own coverage. And if you're incarcerated, you don't have to be covered because, hey, you're on the taxpayer's dime. You're going to get the best medical care in the world. All right, these are the requirements. If you have a government-sponsored program, we talked about some of these, you do not have to worry about it. You already meet the criteria. If you're in an eligible employer health plan, your employer should have let you know whether you are in an eligible plan or not. If you go in under the exchanges, if you can get in the website to get on one of the exchanges, you would not. You would meet the criteria and you wouldn't have to worry about any of the penalties. And there are some grandfathered health plans. I have not seen any of those. I'm not sure where they come up with their criteria for who can be a grandfathered plan and who can't. I don't think it's going to be a real common case anyway. And if you're under a state health benefit pool, you don't pay a penalty. As part of the exchange, they're going to have what they call premium assistance. This is something that's been kind of confusing, and it's really, really important and easier to understand than what you might think. What you get through the premium assistance plan is refundable tax credits that help pay for the plan. For instance, if you have to pay $2,000 a month for the plan under the exchange, and based on your income, you may qualify for $1,500 of a credit, which means you'd only have to pay $500 for this $2,000 insurance plan. But the credit can't actually be computed until you file your tax return at the end of the year. So what happens when you register for this exchange, they're going to compute what they think your credit's going to be based on income that you're able to provide from the prior year. So they're going to compute the credit. They're going to offset your cost of your premium by this credit amount. And at the end of the year, it's kind of reconciled. So if they've given you more of a credit than what you're entitled to, you're going to pay it back when you file your tax return. Or if you go ahead and take the exchange and get the credit, and at the end of the year they've underestimated, you're going to get that money given to you because it's a non-refund, or it is a refundable credit, so you will get that at the end of the year. So, you know, I'm not going to go through all the computation because it's really complex, and quite frankly, I don't know if I even know it. I'd have to go through my notes and follow it. I won't have to compute it until we do your tax return. Okay. This is my next presentation. Hope you want to stay and join me, and you can.